Hello there. Welcome to the Entrepreneurship Center. My name is Desmond, one of the managers here, and in today's video, we're going to talk about debt financing for business owners. Now, by basic rough definition, debt financing is essentially the act of procuring capital from a third party or an outside source with the future intent to repay. Think about it like this. Have you ever been in a situation where you had expenses for your business that you had to cover today, but either you didn't have the cash to support, or you found that you had an option to go get credit where it may have been cheaper to use the credit instead of your own personal money? Things like payroll, inventory, advertising, or maybe paying off a business partner who exited the business, right? These events happen. Sometimes they are recurring, sometimes they are one-time events, but nonetheless, there is a reason for debt financing, and we're kind of going to go through those things today. Now, normally there's two different categories of debt financing that most lenders allow business owners to utilize to get funds from them. The first is something that we call credit-based. And this is normally what most folks know about lending. It's credit-based is normally something that looks at your past to be indicative of how good of a borrower you're going to be into the future, right? And then the second is asset-based. Asset-based normally takes a few different formats, but essentially that is the process in which you can show something or provide something of real value, and the lender says basically, if you don't pay me, I can take that back from you, right? That's a little bit different from credit-based. So we have credit-based and we have asset-based lending. Now, in the credit-based area, as you see here, there's two segments within credit-based lending. And the first one is probably the most popular one for most entrepreneurs on the planet that have access to any type of credit system, and that's a personal credit system, right? In the United States specifically, the personal credit system goes back a long period of time. But what I actually just found out was that one of the most popular, actually the most popular credit system in the United States was actually just implemented in 1989. That's the FICO system, the Fair Isaac Corporation located in California. Actually, this company was created from two Stanford graduates. One was a statistician, the other was an engineer. I think it was Bill Fair and Earl Isaac. Both of those gentlemen were really fascinated with making decisions and improving the accuracy of credit and also wiping away discrimination, right? You know, back in the 50s and the 40s when folks used to go get credit, it was really at the judgment of the individual banker. And so if the banker didn't like the person, regardless of, gender or skin color or anything like that, they just would deny it, right? Even if they were credit worthy. But on the flip side, if someone, was not eligible for the actual loan or the debt, you had bankers that would actually approve it, and that would put the banks at risk. So essentially, that's really where the Fair Isaac Corporation, kind of birthed. And both of those graduates, again, are from the University of Stanford. They started the company in 1956, and over about a 30-year period, and I'm skipping a whole lot of stuff here, basically what they did is they essentially privatized scoring technology and models. So they reach out to the top 50 lenders across the United States and basically said, hey, you will have a higher level of risk mitigation based on your funding and your lending if you use a scoring system like ours to make credit-based decisions, right? So they did that over a 30-year period, and then in 1989 they were able to essentially convince the country that a broad-based credit scoring system would be beneficial. And for many of us that are in the United States or have a social security number, have done anything in the credit system, normally your financial life is dictated by about 3 little digits, and that's your credit score. It could be a 700, it could be a 580, it could be a 625. But normally those numbers are highly indicative of what we are able to borrow or what we are unable to borrow, and they can make your life really difficult if that's your only option, or it can make your life very easy. Now, from a range standpoint, the FICO system I think has been recently updated since the financial crisis, but I believe it goes from about 300 to about 850. So obviously the lower you are on the end of that spectrum, the harder it is going to be and the more risky that you look to lenders. But the higher you are on that system, the less risky you look to lenders and the higher chance that you're going to get the best capital at the best interest rates possible. Normally when it comes to credit in a credit system, normally lenders use something called the 5 C's to make decisions. The first is character. That is essentially a review of your payment history, your payment record, right? Have you made past payments on time? How many vendors or suppliers or individuals have you made payments to, and were they also happy with you, right? Number 2 is the capacity. Capacity is your ability to repay. Now this is different from your past. Your ability to repay looks at the present, and it helps understand, okay, do you have the cash flow to essentially manage the debt service needed to repay back the loan? Number 3 of the 5 C's is the capital. What capital are you contributing to the deal as a borrower? Normally when more capital is contributed to a deal from the borrower side, basically what happens is there's a higher chance of getting the loan because there's less chance for a default because now the borrower's got their own skin in the game. Now from a personal standpoint, normally folks know this kind of scenario on a home mortgage. Normally they put a down payment depending on whether it's an FHA loan or a different type of loan. It might be 5% or 20%, what have you, and then the bank comes in and actually finances the rest through a 15 or a 30-year mortgage, right? The 4th is collateral. And essentially collateral is your repossession ability. Now, most people don't break it down like that, but that's just the truth. Lenders want to know, what can I take from you if you default, right? So that's your repossession ability. And the less you have to repossess, if that's the only thing or one of the main things that are they're basing your lending decision on, there's probably a lower likelihood that you're actually going to get the loan that you need. The 5th and final of the 5 C's is essentially conditions. What are the usages, or what is the usage of the funds, right? Are these funds going to be put towards a business? Are these funds going to be, obviously since it's a business video, they should be put towards a business. But normally when people go get loans, they could go and do home remodeling. They could use it personally to kind of bridge personal cash flow gaps. But obviously in this video, you're normally going to be, financing one of a few things. It's normally going to be payroll. It's normally going to be inventory, advertising, or some past debt that may have caught up with you in your business that you borrowed from the past that you're trying to make sure doesn't cripple your business in the future. So let's look at your second option from a financial standpoint in a credit-based lending system, your business credit, as you can see right here. Now, business credit, while it's not normally used unless businesses kind of or individuals kind of really get to a point to where they're really trying to grow a business that's bigger than them. You do find people that use business credit in kind of some weird ways, but I'm not really talking about that type of usage. I'm talking about if you're really trying to establish strong business credit and you're in a real business and you're really trying to grow something. You've got staff, or you got high levels of revenue, you got suppliers, you got expenses, entities that really are going to need this down the line. Now, just like personal credit, business credit is heavily predicated on the past, on your history, your ability to manage debt, your ability to pay your suppliers, your ability to meet your obligations. And in business, it's difficult to do, right? Because you can make an obligation today and really feel confident about it because of your revenue or the prospects on the horizon or the things that are going on, and then just around the corner something can blindside you, right? So it's very difficult to manage. Because you're only making decisions with what you have available to you today, the same as when your lender or your creditor is making those decisions. But nonetheless, the system does exist. Now, there's a company that many of us know. It's one of the largest financial services companies in the United States and actually the world now at this point, called Dun & Bradstreet. Dun & Bradstreet back in 1933 became the company that we actually know it today as a result of a merger between two different companies. Now, about 30 years later, fast forwarding to 1963, Dun & Bradstreet actually standardized and formalized the business credit system by coming up with the DUNS system. DUNS, D-U-N-S, stands for Data Universal Numbering System. Now, this system is very similar to FICO because it actually provides an environment in which lenders and borrowers can actually evaluate each other, and mostly where lenders can evaluate borrowers, right? Now, what's interesting about this system is it's a little bit more simple compared to FICO. It's kind of more straightforward. One of the things that's actually pretty interesting and simple about it is the range, right? A range, as we've talked about in some of my other videos, is basically an area of variation between upper and lower limits, right? So with the FICO system, you've got 300 to 850. That's the range, and if you're on the lower end of the spectrum, you're probably not going to get any credit. If you're on the higher end of the spectrum, you're probably going to get a lot of credit and credit for cheap. Very similar in the DUNS system. The only difference is the range is numbered differently. So we have the beginning of the DUNS range is actually 0, and the end of the DUNS range is actually 100. And it's pretty much straightforward. It's not like all this crazy stuff going on. I mean, they have a lot of complex calculations behind the scenes, but as many of you know, if you've looked at like your personal credit report and you've tried to increase your credit score, you try to manipulate, it's kind of difficult to do. But with your business credit, it's actually pretty straightforward. They just want to know, hey, who are your creditors? Who are your suppliers? Are you paying them as agreed? Even if that means you're paying them 30 or 40 or 60 days after the fact, they just want to know that you are staying in alignment with the agreement. So that is, the range 0 to 100, and that is kind of the basis of the system. Now, each business entity that signs up to become a part of that system is actually issued a 9-digit number called the DUNS number. Now, the DUNS number is not to be confused with the actual score. The score itself is called a Paydex score, very similar to with personal credit. It's called personal credit score is called a FICO score, right? So a Paydex score, is anywhere from 0 to 100, and normally a good score is around 80 or above, and it's actually pretty easy to get that. One thing I will say about business credit, I've got some limited experience with it, but I do have experience with it, is basically try to get your suppliers, folks that you wouldn't normally think of as creditors. Normally we think of creditors as people we actually owe money to, but our suppliers are normally who we're procuring inventory from, right? We're buying, if we've got a lumber company, we're buying wood from our wood supplier. Well, no, if we're a furniture company, we're buying wood from our wood supplier, and then we're trying to turn that into furniture, for example. Like, look at a company like IKEA. They've got, wood suppliers, they've got plastic suppliers, they've got all these raw material suppliers. If you're a company that is like that, where you have suppliers and you want to actually jumpstart your business credit, what you'll want to do is you'll want to reach out to your supplier and create a trade credit agreement. Trade credit is essentially an arrangement in which you can receive materials or inventory today and then pay for them down the line. So if you've ever heard of something called net 15, or ever heard of a phrase net 15, net 30, net 60, net 90, all that basically means is you can receive something of value today and then pay for it 15, 30, 45, 60, 90 days into the future. Once you do that, then you can have your supplier actually start to report your on-time payment history built on the trade credit agreement that you both have, and that's how you can jumpstart and also manufacture and control your business credit score. And I would highly recommend you do that, because you never know when something's going to come around the corner and blindside you, where you may have to, unfortunately default on an agreement, or you may have to pay some of your payments late. So the more of that payment history that you can jumpstart and manufacture will increase your Paydex score and will protect you against the risk that you cannot foresee in the future. So, in summary, Dun & Bradstreet is the company who's formalized it. 1933 with the merger, 1963 they came up with the Dun system, and now every business entity has a 9-digit number on a 100-point range, and then you have a Paydex score anywhere from 0 to 100. So now that we've talked about how to procure debt financing in the credit-based lending system, we're going to now talk about how to procure the financing in an asset-based lending system. By basic summary, the difference with an asset-based lending system and a credit system is that the lender is transferring capital to the borrower under the premise that they can grab or take something of value in the future if there's a late payment or, more importantly, a default, right? So, with the credit system, the best they can do is kind of come after the funds, including, like legal fees, and they can kind of make your life difficult. And they can come after assets if they pierce something called the corporate veil, right? So we'll get into that in another video. But it's much easier for an asset-based lender to take something you have, because you're literally declaring it up front in terms of their ownership of that for a temporary period of time until you've actually paid back the loan or the advance. And oftentimes that actually comes in the form of a lien, which is very different with your personal credit or business credit, because you don't have a lien up front. That may happen down the line after court procedures and getting a judgment and all that, but it's very different. With all that said, I actually do prefer asset-based lending. I think it's a bit more democratic, and I think for the little guy, it's kind of a better way to get funding, because it's very binary. Either you have something of value or you don't. And you can manufacture something of value if you can find a business where you have a product market fit and you can start to generate revenue. If you can ramp up that revenue north of $10,000 a month, and if you're in an industry where some of these lenders look at being credible and safe, then you could really have a shot at least to get a loan or to get an advance. You can't really say that with personal credit or business credit. Business credit is a little bit easier, but it takes a long time to actually build. So yeah, let's get right into it. The first type of asset-based loan is going to be a cash flow loan. Now, normally on a cash flow loan, the big thing that they see importance on is your revenue. So the first thing they're going to do is they're going to look at your monthly revenue. Okay, is that strong? Does it meet our criteria? Then they're going to be thinking, okay, well maybe there's an opportunity in the future to lend you money today, but actually make the principal back by payment from your cash flow in the future, in addition to something called a factor rate or an interest rate, which is the cost of them giving you the capital and them not having it in their own pocket. So normally on a cash flow loan, we're looking at the present and the future, but then we're also double checking with the business by looking at the past. And normally they do that by looking at 3, 6 or 9 months worth of bank statements, and then they're also going to ask for your credit card processing as well, because cash flow lenders, they really like to do like a small daily withdrawals or weekly withdrawals, sometimes monthly if you're lucky enough and you know how to negotiate, but normally it's daily or weekly withdrawals, and they want to do that straight out of your Visa, MasterCard, or Discover payments that you're getting from your customers. They place a high value on your future accounts receivable, because that's the asset that they want to lay claim to through a lien in the event that you default and don't pay. Now, let's say you get a yes decision, right? They say, hey, you're doing $20,000 a month, $25,000, $30,000 a month. We're going to give you this advance, or we're going to give you the loan. Now, what comes into play is something called the loan to value ratio. You would think that, hey, if you're doing $20,000 a month annualized over a year, you have $240,000. They're going to give you a loan against that amount. No. They're going to give you a loan against 1 month's worth of revenue. And normally on a cash flow loan, it's going to be, the ratio is going to be somewhere between 75 to 90%. So let's say you're doing $20,000 a month, you get an 80% loan to value ratio. That means you're going to get an advance or a disbursement of about $16,000. That's kind of what that means, right? Which is really not too bad when you kind of consider what you don't have to do to get this type of loan. Let's look at the second type of asset-based loan, which is something I call a hard asset loan. A hard asset loan differs from a cash flow loan for one primary reason, and that's the item of value, the asset in which they are placing as the primary one that they are making their decision on. So in a cash flow loan, they're making their decision on your monthly revenue, which is cash, liquidity, right? Being able to grab that cash from your customer in the future and being able to line their pockets with it if you're unable to pay. But with a hard asset, they're actually looking at the present primarily and trying to figure out, okay, well, what does Desmond have that I can take? Does he have real estate? Does he own the building in which his business is operating in? Does he own valuable equipment? Like, if you have a pizza shop and you have a pizza oven, that piece of equipment may be valued at $20,000 fair market value. Now, they're probably not going to be able to get $20,000 for it if it's used, but they may be able to get 10 or 15, and they're going to try to claim some other assets, hard assets that you have in order to get that amount, plus any type of collection fees they're going to tack on. So it's good for you to actually understand the market liquidation value, because you want to be able to use that to maximize the value of the assets, which would then in turn maximize your loan to value ratio. Normally when you go to get a loan, especially if you get decent terms, you probably want to maximize your disbursement, because it's probably going to be few and far between in terms of the amount of times where you can actually get another loan, right? So if you can get as much as you can, as long as you can obviously service the debt and pay it back responsibly, then the way to do that is to understand the market liquidation value, which is going to make your loan to value ratio stronger when they loan against the asset. So there's a couple of different financial products that our good friends from Wall Street have come up with. One is a merchant cash advance. A merchant cash advance is essentially an advance against an asset, normally with somewhere between a 70 to 90% loan to value ratio, regardless of what the asset is, whether it's the cash flow or whether it's the hard asset. And normally you can get these loans at essentially very high interest rates. They call them factor rates, actually. But the cool thing is that you can get them very quickly. So if you needed money tomorrow to meet payroll, or your machine in your bakery broke down and you need to be operational tomorrow, normally this type of loan or advance you can actually get within 24 to 48 hours, but you will pay for the speed. So to give you an idea, let's say you get a $16,000 disbursement. Normally that term is going to be a 6-month term, almost like a short-term loan. And normally the withdrawals are going to be on a daily basis or a weekly basis, unless your negotiation skills are strong and you know a little bit about the MCA industry, then you might be able to negotiate the monthly. But the kicker here is the factor rate. And the factor rate is a different way for these lenders to describe an interest rate, right? And it's very different from an interest rate. Number one, because it's more expensive, but number two is that you can't avoid paying the full amount. So let me give you an example. If you get $16,000 and you have a 1.20 factor rate, that means you have to multiply 60,000 times 1.20, and that means your repayment amount is going to be about $19,200. And that $3,200 of factor rate value is going to be put on your loan from day one. So whether you pay that loan off on day 2 or day 180 at the end of the 6-month term, doesn't matter, you got to pay the full amount. That's one of the fundamental differences from getting a credit-based loan from getting an asset-based lending loan or an advance. So I actually still think it's pretty good. If you can manage it and if you can have an investment opportunity, or if your situation is such in a dire state where you have to protect your business and this you can save your business. Look, a lot of people are always like, well, okay, well, that's expensive. Well, everything's relative. So if you have no other options, it's your cheapest option, right? So just remember that. If you got to save your business or you got to take advantage of an expansion opportunity, then you could definitely use the capital to do that. Just make sure that you won't default on it, because their collection activities are really aggressive. Now, the second product you have here is an Invoice Advance. An Invoice Advance is a little bit different than a Merchant Cash Advance. Merchant Cash Advance is looking to the future to lay claim and put a lien on your accounts receivable. And normally that's money that has not been earned yet, right? So accounts receivable oftentimes is money that you anticipate coming because of what's happened in the past, but you haven't necessarily traded services or products for that money. That's a very important distinction. With an Invoice Advance, however, the risk mitigation is higher for the bank, or it's just less risky to give you a loan based on this, because you've actually performed the work. You've actually transferred the product or the services to your customer, and now it's literally a waiting game. Sometimes, in the tech service-based world, you'll find this with web designers where, they may have a $10,000 website and they may be paid in 3 installments, $3,333 here, $3,333 there, $3,333 at the end. And let's say that, they've got contractors or they got to meet payroll and they're like, dude, I can't wait another 30 days to get this remaining installment. They will take the invoice to a lender and say, hey, look, I've got a trade credit agreement with my customer that's going to pay me on a net 30, but I need the money now. So what I need you to do is I need you to turn this invoice into money by running a loan to value ratio calculation on it and tell me how much I can get for it. Normally what's going to happen on an invoice is they're normally going to give you around 90% of the invoice. So if you've got, let's say, $3,000 left that you need to be paid from your customer, normally you're going to be able to get $2,700 in a disbursement. That remaining $300 in value that was on the invoice is going to go to the factoring company, and then you're going to pay like 1% a week or 1% every 2 weeks or something like that until they actually get their money. So it is pretty expensive, but it is a good way to get the money in the door now, and the loan to value ratio is normally going to be higher because the services have been earned instead of unearned. The next type of loan, normally reserved for like big businesses, is a bridge loan, and that's exactly what it is. It's a high interest loan, normally with a very short term. The term is normally about 4 months, and that's basically a bridge to get you from this event to this event, or this mountain peak to this mountain peak. And otherwise, if you don't have the bridge loan, you could default or the business could go under, and often in many cases, and that's why people take them. The final type of product that where asset-based lending has gotten pretty creative is something called a line of credit, but not like a normal line of credit, a short-term line of credit. So in a short-term line of credit, normally you're, it's like an installment loan, and it's cheaper normally than a Merchant Cash Advance or an Invoice Advance. There's companies like Blue Vine and Cabbage, and I think On Deck has a short-term line of credit product. What those companies normally do is they'll basically say, hey, we're going to grant you this amount of money, and you can use this money anytime you need it. So as you pay back, the balance or the money available actually increases, and then you can draw again. That's very different from a Merchant Cash Advance where once you get your disbursement, you can't get any more money until you go apply again. And it's very different from an invoice, because once they've given you a disbursement, that's it. That transaction's over. It's not like a recurring, ongoing thing. So a short-term line of credit is actually pretty good because you only have to get approved one time, and once you do, you can actually start to dictate how you use that money. So anyway, I wanted to give you guys an overview of the the basics of debt financing, because we don't often talk about that when it comes to actually generating capital, especially like at self-employment stage or trying to grow to like early stage, what I call stage 4, which is early business owner, where you have staff. and all that. But I hope this gives you a good idea of the difference between the credit-based system and looking at the past as an indication of your future versus an asset-based system, which is strongly looking at your present and your future as an indication of a credit granting decision. My name is Desmond, the manager here at the Entrepreneurship Center, and I hope you found value in this video, and we'll see you in our next post.